What if I told you that the single greatest book on trading wasn't written by a Wall Street quant, a legendary hedge fund manager, or a hotshot economist? What if I told you it was written by a psychiatrist who escaped the Soviet Union before the 24/7 news cycle turned investing into a spectator sport, before social media could create an army of traders overnight, before you could carry the entire global market in your pocket? A time when winning in the markets depended not on the speed of your internet connection, but on the mastery of your own mind. It sounds like a paradox, right? How could a doctor, trained to understand the complexities of the human psyche, write the definitive guide to the cold, hard, data-driven world of finance? How could a man whose expertise was in human emotion teach you more about navigating the chaos of cryptocurrency, the hype of Tesla, or the FOMO of a meme stock rally than any technical analyst? The answer is simple, and it is the most important lesson in all of finance. Because the market is not a collection of numbers and charts. It is a collection of people. It is a vast, global expression of human hope, fear, and greed. And you cannot hope to win the game if you do not first understand the players. And the most important player of all is you. This was a profound discovery of Dr. Alexander Elder, a man who fled totalitarianism, became a successful psychiatrist in New York City, and then found his ultimate challenge in the financial markets. He realized that trading was the most psychologically demanding endeavor a person could undertake, and that success or failure was determined not by a secret indicator, but by a trader's ability to achieve emotional discipline and intellectual honesty. Welcome to Capitura. Today, we are not just reviewing a book. We are undergoing a psychological examination. We are taking an audiobook-style journey to the definitive guide to mastering the inner game of the markets. Trading for a Living by Dr. Alexander Elder. This is not a simple summary. This is a complete framework for becoming a disciplined, intelligent, and professional-minded trader. We will explore Elder's legendary 3 M's, mind, method, and money, a 3-legged stool that provides the stability needed to succeed in a world designed to throw you off balance. Stay with us, because the principles in this book are the foundation of a successful trading career. They are the psychological shield that will protect you from your own worst impulses, and they are the operating system that will allow you to approach the market with the cool, calm professionalism of a master. Introduction: The Psychiatrist Couch on Wall Street. Dr. Alexander Elder's story is as compelling as his trading philosophy. Born in the Soviet Union, he trained as a psychiatrist and a ship's doctor. As a young man, he was unwilling to live under a repressive regime. In a daring move, he jumped from a Soviet ship while it was docked in Ivory Coast, Africa, and made his way to the U.S. Embassy. He was granted political asylum and started a new life in New York City. He built a successful psychiatric practice, but he was fascinated by the markets. He saw them as the ultimate puzzle, a place where logic, emotion, and mass psychology collided. He began trading, and like nearly everyone else, he lost. He tried different methods, followed different gurus, and made all the classic mistakes. But unlike most people, he had a unique lens through which to analyze his failures. His psychiatric training. He realized that his losses were not due to a lack of intelligence or a bad system. They were due to psychological flaws. He was making impulsive trades. He was letting his ego prevent him from cutting losses. He was trading out of boredom or excitement rather than from a clear, rational plan. He saw that the market was a perfect mirror, reflecting his own internal weaknesses back at him in the form of financial losses. This insight was the genesis of Trading for a Living, first published in 1993. The book was a revolution because it was the first to put psychology front and center. While other books focus exclusively on chart patterns and indicators, Elder argued that this was like giving a scalpel to a medical student who hadn't studied anatomy. The tools are useless and even dangerous without a deep understanding of the underlying subject. And in trading, that subject is yourself. Elder's central thesis is that to succeed, you must become a professional. A professional trader is not someone who makes a lot of money. It's someone who approaches the market with discipline, a clear plan, and emotional control. An amateur is ruled by their emotions, and the market is a very expensive place to discover your emotional weaknesses. So, why does this book from the pre-internet era matter more than ever today? Because the challenges to our psychological discipline have multiplied 1,000-fold. Think of the modern investing landscape. The culture of Robinhood and other commission-free apps has turned trading into a fast-paced, dopamine-driven video game. The app is designed to encourage activity and impulsive decisions, the very things Elder warns against. Consider the powerful FOMO, fear of missing out, that grips you when you see a meme stock like GameStop or AMC exploding on Reddit's Wall Street bets. Your rational mind might tell you to bubble, but the emotional pull of the crowd is immense. Elder's work is a manual for how to recognize that emotional hijack and stick to your own rational plan. What about the wild volatility of cryptocurrencies like Bitcoin? The price can swing 20% in a day, triggering extreme levels of greed on the way up and gut-wrenching panic on the way down. Without the psychological framework Elder provides, navigating this market is impossible. You will inevitably buy the top and sell the bottom. Even for those on a more conservative path of the FIRE movement, financial independence, retire early, who build wealth through ETFs, Elder's wisdom is crucial. What do you do when a bear market erases 30% of your net worth? The amateur panics and sells, locking in their losses. The professional, armed with the psychological discipline Elder teaches, understands that this is a normal part of the process and sticks to their long-term plan, perhaps even buying more at lower prices. Trading for a living is not a book of secrets. It's a book of profound and often uncomfortable truths. It is built around the elegant and powerful framework of the 3 M's: mind, method, and money. Mind, the psychology of the individual trader. Method, the system for analyzing the market and finding trades. Money, the risk management rules that ensure survival. Elder argues that these 3 are like the legs of a stool. If any one of them is weak, the stool will collapse. Most traders spend 90% of their time on a method, looking for the perfect indicator. Elder insists that at least 90% of your success will come from mind and money. In the chapters that follow, we will break down this complete system piece by piece. We will start with the most important M, your own psychology. We will then explore the tools of technical analysis, not as a crystal ball, but as a way to read the behavior of the market crowd. We will build a complete trading system using Elder's famous triple screen method. And finally, we will cover the ironclad rules of risk management that will keep you in the game. This is more than a book summary. This is a complete course in becoming a mature, disciplined, and intelligent market participant. Let's begin that chapter-by-chapter breakdown. We will explore Elder's masterpiece by following its logical progression, from the inner world of the trader's mind to the practical application of systems and risk management. Part 1, Mind, the psychology of the individual, the timeless principle. Elder begins his book not with charts or indicators, but with a deep exploration of the trader's own mind. This is a foundation upon which everything else is built. His opening argument is stark and brutal. The vast majority of people who try to trade will fail, and they will fail for one simple reason: they beat themselves. The market doesn't beat them. Their own psychological flaws do. He paints a vivid picture of the market as a vast, deep ocean. The average person, the amateur, comes to this ocean with a flimsy raft, no map, and no understanding of the currents. They are driven by hope and greed. When a good wave comes, they feel like a genius. When a storm hits, they are thrown into the water and drown. The professional, however, is like a skilled surfer. They study the ocean, they respect its power, and they have a plan. They know which waves to ride and, just as importantly, which waves to let pass. They know how to handle a wipeout and get back on their board. Elder identifies the primary psychological traps that destroy amateurs. The lure of gambling. Many people come to the market not to make money, but for the thrill of the action. They crave the excitement, the dopamine hit of a winning trade. Elder, the psychiatrist, argues that many have a subconscious gambling addiction. They will inevitably trade too often and too large, and their true goal is not profit, but the emotional high. As he says, the market is a very expensive place to find entertainment. The problem of self-sabotage. This is a deep psychiatric insight. Elder claims that many people have a subconscious desire to lose. They may feel they don't deserve success, or they may be reenacting a pattern of failure from other areas of their life. These traders will always find a way to snatch defeat from the jaws of victory, breaking their own rules at the last second, moving a stop loss just before a big loss, or failing to pull the trigger on a perfect setup. the inability to accept a loss. For many, being wrong is a direct blow to their ego. When a trade goes against them, they can't accept the small loss. They hold on, hoping it will come back to even. The small loss grows into a medium loss, and then a catastrophic loss. Their need to be right is more powerful than the desire to make money. Emotional decision-making. The amateur trader is a slave to their emotions. They buy in a state of euphoria when a stock is soaring, and they sell in a state of panic when the market is crashing. The professional, in contrast, has a predefined plan and executes it with the cool detachment of a surgeon. Elder's prescription for these maladies is to embark on a journey of radical self-awareness. He insists that every trader must keep a detailed journal. This journal should not just record trades, but also the trader's emotional state. Why did I take this trade? Was I feeling greedy, fearful, bored? By reviewing this journal, a trader can identify their destructive emotional patterns and begin to correct them. The goal is to transform trading from an emotional roller coaster into a calm, disciplined, and even slightly boring business operation. Modern takeaway. Dr. Elder's diagnosis of the amateur trader psychology is a perfect description of the culture that has emerged around modern trading apps like Robinhood. These platforms are not neutral tools. They are brilliantly designed to amplify the very psychological flaws Elder warns about. The lure of gambling, the confetti animations for making a trade, the lists of top movers, and the easy one-click access to highly leveraged options are all designed to create a sense of excitement and action. The app itself encourages you to feel like a gambler in a casino, not a professional running a business. Emotional decision-making. The constant price updates and the red and green flashes on the screen are a form of psychological manipulation. They are designed to trigger an emotional response. Fear when the numbers are red, greed when they are green. This creates an environment where it is almost impossible to make a rational, pre-planned decision. Elder would argue that the first step to professionalism is to turn off these notifications and engage with the market on your own terms, not the apps. The world of cryptocurrency is another area where Elder's psychological insights are paramount. The extreme volatility of assets like Bitcoin and altcoins creates an emotional storm. The incredible gains during a bull run produce a level of euphoria and greed that is off the charts, leading people to mortgage their homes to buy at the top. The subsequent 80% crashes induce a state of pure terror and panic, causing them to sell at the absolute bottom. Elder would say that you cannot even begin to trade crypto until you have done the work on your own mind. You must have a plan, you must understand your own emotional triggers, and you must have the discipline to stick to your rules, or this market will chew you up and spit you out. Elder teaches us that the first chart you must learn to read is the chart of your own emotions. Part 2. Mind, the psychology of the crowd, the timeless principle. After examining the individual, Elder zooms out to analyze the psychology of the market as a whole, the crowd. He argues that when people come together in a group, their collective intelligence often drops. The crowd is driven by primal emotions, not logic. It is prone to waves of extreme optimism and extreme pessimism. The amateur trader gets swept up in these waves, becoming just another anonymous face in the mob. The professional stands apart, observing the crowd behavior and using it to their advantage. Elder introduces a few key concepts for understanding mass psychology. The market is a manic depressive. This is similar to Benjamin Graham's Mr. Market allegory. The market crowd swings between wild, irrational euphoria and deep, unjustified despair. The professional trader's job is to identify these emotional extremes and bet against them. They must be willing to sell when the crowd is screaming buy, and buy when the crowd is convinced the world is ending. Consensus and contrarianism. The news media, Wall Street analysts, and popular opinion often create a powerful consensus view. Elder warns that by the time an idea becomes a consensus, the big move in the market has often already happened. The professional looks for opportunities by questioning consensus. However, he offers a crucial distinction. Being a contrarian does not mean blindly betting against a trend. A true contrarian waits for the primary trend to show signs of exhaustion, for the crowd to reach a peak of emotional intensity, and then looks for a spot to fade the move. Reading the crowd with indicators. Elder explains that we can use certain technical indicators not as mechanical by sell signals, but as tools to measure the psychology of the crowd. For example, Commitment traders COT report. This shows the positions of large commercial hedgers, large speculators, and small speculators. Elder notes that the small speculators are usually on the wrong side of major market turns. Sentiment surveys. Polls that ask investors if they are bullish or bearish can be powerful contrarian indicators. When an extreme percentage of investors are bullish, it often signals a market top. When they are universally bearish, it can signal a bottom. The core lesson of this section is that the market is a game of transference. The smart, professional money patiently waits for the emotional, amateur money to make a mistake, and then takes their money from them. To be on the right side of this transfer, you must learn to detach yourself from the emotions of the crowd and think like an objective, independent analyst. Modern takeaway. In the 21st century, the market crowd that Elder described has a new home: social media. Platforms like Twitter, TikTok, and especially Reddit's Wall Street Bets are the modern embodiment of mass psychology. They are digital mobs that can create powerful narratives and move markets with breathtaking speed. The meme stock phenomenon is a perfect case study in Elder's principles. In 2021, a massive online crowd organized to buy shares of GameStop and AMC, driven by a narrative of U.S. versus the hedge funds. The emotional intensity was off the charts. The consensus in that group was to HODL, hold on for dear life, and never sell. An Elder-trained professional would have stood apart from this frenzy. They would have recognized it as a classic case of crowd euphoria reaching a manic peak. While they might have ridden the trend on the way up, they would have been looking for the exit as the emotional intensity became unsustainable, selling their shares to the last wave of euphoric amateurs who bought at the top. Similarly, the crypto market is heavily influenced by the social media crowd. The price of an altcoin can explode based on a hype campaign or an influencer's endorsement. This is pure crowd behavior. Elder would teach a trader to be extremely skeptical of these moves. He would advise using sentiment analysis tools, which today can algorithmically scan Twitter for bullish or bearish sentiment, as a contrarian indicator. When the entire crypto world is screaming about a new paradigm and 100x gains, the professional is quietly taking profits. When the market has crashed and social media is filled with despair and declares crypto dead, the professional is calmly looking for bargain entry points. Elder's wisdom teaches you to view social media not as a source of good ideas, but as a real-time sentiment gauge for the amateur crowd. Your job is not to follow the crowd, but to understand its emotional state and use that information to make rational, independent decisions. Part 3. Method, Charting, and Technical Analysis. The timeless principle. Having established the primacy of psychology, Elder now turns to the second M, method. This is a trader's toolkit for analyzing the market. He is a firm believer in technical analysis, the practice of studying price charts and volume to forecast future price movements. He argues that a chart is nothing more than a picture of mass psychology. Every tick up or down represents a transaction, a skirmish in the ongoing battle between the market's bulls buyers and bears sellers. The technician's job is to analyze this battle and determine who is winning. This section provides a clear and practical introduction to the core concepts of classical charting. The chart. Elder explains the basics of chart construction, bar charts, candlesticks, and emphasizes that the chart contains all the information a trader needs. The price reflects the sum total of all knowledge, opinions, and emotions of every market participant. Support and resistance. These are the fundamental building blocks of chart analysis. Support is a price level where buying pressure is strong enough to overcome selling pressure and halt a decline. Resistance is a price level where selling pressure is strong enough to overcome buying pressure and halt a rally. These levels are created by the memory of the market crowd. Traders remember where prices turned before and tend to act at those levels again. Trend and trading ranges. A market can be in one of two states. It can be in a trend, making a series of higher highs and higher lows for an uptrend, or lower lows and lower highs for a downtrend. Or it can be in a trading range, bouncing between clear support and resistance levels. Elder's key insight is that you must use different strategies for each condition. You should use trend-following indicators and methods when the market is trending and oscillators that identify overbought/oversold levels when the market is in a range, volume. Elder places huge importance on volume. Volume, he says, is the gasoline in the tank. A price move on high volume is a sign of strong conviction and is more likely to be sustained. A move on low volume is suspect and could be a trap. He looks for volume to confirm the strength of a trend. The beauty of Elder's approach is his pragmatism. He doesn't present these tools as a magic crystal ball. He presents them as a logical way to measure the balance of power between bulls and bears. A breakout above a resistance level on high volume is a clear sign that the bulls have won the battle and the price is likely to go higher. A breakdown below support on high volume shows the bears are in control. It's a simple, powerful, and visual way to analyze the market's behavior. Modern takeaway. In an age of complex algorithms and instant news, the simple elegance of Elder's classical charting principles is more valuable than ever. These concepts act as a filter, allowing a trader to cut through the noise and focus on one thing that actually matters: the price action. Take the stock of a high-profile company like Tesla. On any given day, there are dozens of conflicting news stories, analyst upgrades and downgrades, and tweets from its CEO. An investor trying to make sense of this news flow will be whipsawed and confused. An elder-trained technician, however, would simply pull up a chart. They would identify the major long-term uptrend. They would draw the key support and resistance levels. This simple framework will provide a clear, objective map of the battlefield. It will allow them to see that, despite the daily noise, the bulls have been in control for years. They could then use pullbacks to key support levels as low-risk entry points, completely ignoring the distracting headlines. The principles of support and resistance are also critical for navigating the volatile world of cryptocurrencies. A Bitcoin chart clearly shows major price levels where battles between buyers and sellers have been fought. The $60,000 level was a major resistance zone in 2021, and the $30,000 level acted as major support. A technician would use these levels to manage their risk. They might buy near support with a tight stop loss just below it, or sell near resistance. This provides a logical, repeatable strategy in a market that often seems completely irrational. Even for the long-term passive investor in the FIRE movement, a basic understanding of charting can be a powerful psychological tool. By looking at a 50-year chart of the S&P 500, they can see that bear markets' downtrends are a normal and recurring feature. They can see how the market has always, eventually, broken through old resistance levels to make new highs. This long-term perspective, provided by the chart, can give them the conviction to stick with their ETF buying plan during a scary downturn, reinforcing the discipline needed for long-term success. Part 4. Method Computerized Indicators. The Timeless Principle. After covering the basics of charting, Elder moves into the world of computerized technical indicators. He was one of the first authors to make these powerful tools accessible to the average trader. However, he offers a crucial warning. Indicators are not a system. They are tools like a doctor's stethoscope or X-ray machine. They help you see what's happening under the hood of the market, but they require intelligent interpretation. An amateur will look for an indicator that is right all the time. A professional understands that each indicator has a specific purpose and provides a different piece of information about the market's health. Elder focuses on a small handful of the most robust and popular indicators, and he is a master at explaining what they are actually measuring. The psychology of the market. Moving averages. A moving average smooths out price data to help identify the underlying trend. Elder calls it the most popular and most useful indicator. An uptrend is confirmed when the price is above a rising moving average. A downtrend is confirmed when the price is below a falling moving average. It's a simple, objective measure of the market's consensus of value. MACD. Moving average convergence divergence. This is one of Elder's favorite tools. The MACD is a momentum oscillator that measures the relationship between two moving averages. The MACD histogram, which he helped to popularize, plots the difference between the MACD line and its signal line. Elder sees the slope of the MACD histogram as a sign of the dominant power in the market. A rising slope shows the bulls are getting stronger. A falling slope shows the bears are getting stronger. A divergence, when the price makes a new high but the MACD makes a lower high, is a powerful warning sign that the trend is losing momentum. The Relative Strength Index, RSI. The RSI is another momentum oscillator that measures the speed and change of price movements. It oscillates between 0 and 100. Traditionally, a reading above 70 is considered overbought, and a reading below 30 is considered oversold. Elder uses it primarily to find divergences. A bearish divergence, price makes a new high, RSI makes a lower high, is one of the strongest sell signals in technical analysis. Stochastics. This indicator compares securities' closing price to its price range over a given period, like the RSI. It's used to identify overbought and oversold conditions, and more importantly, to spot divergences. The key to Elder's approach is that he never uses a single indicator in isolation. He is always looking for confirmation between them, and he is most interested in the powerful signal of divergence, which often flags a major market turning point before it is obvious from a price action alone. Modern takeaway. Today, the indicators Elder wrote about are standard on every free charting platform, from Yahoo Finance to TradingView. Their accessibility is a double-edged sword. Amateurs often slap dozens of indicators on a chart, creating a confusing mess they call a system. Elder's approach is one of elegant simplicity, using a few key tools to gain specific insights. A modern trader can use his MACD histogram divergence strategy to great effect in today's hype-driven markets. For example, during the final leg of the Bitcoin rally in late 2021, as the price pushed to a new all-time high above $69,000, a massive bearish divergence was forming on the daily and weekly MACD and RSI. The price was making a higher high, but the momentum was making a significantly lower high. This was a classic Elder warning sign that the bullish power was fading and a major top was likely imminent. An amateur driven by FOMO would have bought at the top. A technician using Elder's tools would have been taking profits or even looking for a short entry. Similarly, these tools can help an investor analyze a popular growth stock like Nvidia. When the stock is in a strong uptrend, pullbacks that become oversold on the RSI or stochastics can offer low-risk buying opportunities. If, after a massive run, the stock starts to form a bearish divergence on the weekly chart, it could be a signal for a long-term investor to trim their position and take some profits. The crucial lesson is that these indicators are not a crystal ball. They are a way of measuring the market's internal momentum. In today's market, which is so heavily influenced by narratives and headlines, these tools provide an objective look at the underlying health of a trend, helping you to distinguish between a strong, sustainable move and a weak, emotionally driven spike that is likely to reverse. Part 5. Method: the triple screen trading system, the timeless principle. This is the heart of the book's practical method section. After explaining all the individual tools, Elder brings them together into a single, coherent, and powerful trading system, the triple screen. This system is brilliant because it is designed to solve one of the biggest problems in trading: the conflict between indicators on different time frames. A stock might look like a buy on a daily chart, but a sell on a weekly chart. The triple screen system provides a structured framework for analyzing a security on multiple time frames to arrive at a high-probability trading decision. The system works like a series of filters, with each screen forcing the trader to make a decision before moving to the next. Screen 1, the market tide. The first step is to look at a long-term chart, one time frame higher than the one you plan to trade on. If you are a medium-term trader who uses daily charts, your first screen is the weekly chart. The purpose of this screen is to identify the long-term trend, what Elder calls a tide. You use a trend-following indicator, like a weekly MACD or a moving average, to make a strategic decision. You'll either trade with the tide, or you will not trade at all. If the weekly trend is up, you will only look for opportunities to buy. You are forbidden from shorting. If the weekly trend is down, you will only look for opportunities to sell short. You are forbidden from buying. This first screen removes 50% of the bad decisions immediately. Screen 2, the wave. The second step is to move to your preferred trading time frame, e.g., the daily chart. Here, you are looking for a wave that is moving against the tide. If the weekly tide is up, you are looking for a short-term pullback or decline on the daily chart. The goal is to buy into the long-term uptrend at a discount. You use an oscillator, like the RSI or stochastics, to identify when this pullback has reached an oversold condition. This is your low-risk entry zone. You are buying weakness within a long-term uptrend or selling into strength within a long-term downtrend. Screen 3, the ripple. The third and final step is to pinpoint the exact entry. This screen doesn't even require a different chart. It's about timing the entry on the daily chart after the conditions of the first two screens have been met. Elder suggests using a trailing buy stop or sell stop to enter the trade. For example, if you are looking to buy a dip in an uptrend, after the daily RSI becomes oversold, screen 2, you would place a buy stop order just above the high of the previous day's bar. This ensures that the price has actually started to resume its upward move before you get in. It prevents you from catching a falling knife. Your protective stop loss will be placed just below the recent low. The triple screen is a masterpiece of trading logic. It combines strategic, long-term analysis with tactical, short-term timing. It forces the trader to be disciplined, patient, and to only take trades that are aligned to the market's primary trend and offer a low-risk entry point. Modern takeaway. The triple screen system is timeless. It is a complete, professional-grade trading methodology that can be applied to any market and any time frame using today's readily available technology. A modern trader using a platform like TradingView can set up their screens in minutes. A stock trader looking at Apple could use a weekly chart as screen 1, a daily chart as screen 2, and a 4-hour or 1-hour chart as screen 3 to fine-tune their entry. A Forex trader could use a daily chart for the tide, a 4-hour chart for wave, and a 1-hour chart for the ripple. The crypto trader could use a 3-day chart for the tide, a daily chart for the wave, and a 4-hour chart for the ripple to navigate Bitcoin's volatile swings. The system's true power in the modern context is that it provides a structured, logical process that acts as a powerful antidote to the chaotic, news-driven, and emotional environment of modern trading. Instead of impulsively buying a stock because of a positive headline or a Reddit post, the triple screen forces you to ask a series of professional questions. What is the long-term trend? Am I swimming with the tide or against it? Has the market given me a low-risk entry point in the form of a pullback? Am I buying at a wholesale price or a retail price? Has the price confirmed that it is ready to resume the trend? Am I jumping the gun or waiting for confirmation? This disciplined process is the polar opposite of the amateur's impulsive click. It transforms you from a gambler reacting to noise into a strategist executing a well-defined plan. It is perhaps the most valuable practical takeaway from the entire book. Part 6, Money, the Rules of Risk Management, the Timeless Principle. We now arrive at the third and final M, money. Elder argues that this is the M that ultimately determines whether you survive and thrive or blow up and quit. You can have the best psychological mindset and the best trading system in the world, but if you don't have sound risk management, you are doomed. Money management is the defensive side of the game. Its goal is not to make you more money on your winning trades, but to ensure that your losing trades are never fatal. Elder lays out a set of simple, clear, and non-negotiable rules for capital preservation. The 2% rule. This is Elder's cardinal rule of risk management. You should never risk more than 2% of your total account equity on any single trade. Your risk is the difference between your entry price and your stop-loss price, multiplied by the number of shares. For example, if you have a $50,000 account, the maximum amount you are allowed to lose on one trade is $1,000, 2% of $50,000. This rule is a mathematical shield. It means that you could have 10 losing trades in a row and still have only lost 20% of your capital. It makes it mathematically almost impossible to blow up your account, as long as you stick to the rule. The 6% rule. This is a second layer of defense. It states that if your total losses for the month reach 6% of your account equity, you must stop trading for the rest of the month. This rule is a circuit breaker that protects you from your own emotional state. A string of losses can put a trader on tilt, causing them to make angry, impulsive revenge trades to try and win their money back. The 6% rule forces you to take a step back from the market, cool off, review your journal, and figure out what you're doing wrong before you do any more damage. Position sizing. The 2% rule forces you to think in terms of position sizing. Instead of asking, how many shares should I buy? You ask, given my entry and stop loss, how many shares can I buy while only risking 2% of my equity? This takes the guesswork out of the process and ensures that your risk is always controlled. The importance of a stop loss. For Elder, Trading without a stop loss is unthinkable. It is the one tool that allows you to define your risk before you enter a trade. The stop loss must be a hard order placed with your broker, not a mental stop that you can easily violate in the heat of the moment. These rules are not exciting. They are the boring, defensive, and absolutely essential foundation of a professional trading career. They are what allow a trader to survive the inevitable losing streaks and stay in the game long enough for their winning system to pay off. Modern takeaway. In the modern era of high leverage and speculative excess, Elder's money management rules are not just a good idea. They're the only thing that separates a trader from a gambler. Consider the YOLO, you only live once, culture prevalent on forums like Wall Street Bets. It is common to see users posting screenshots of their accounts where they have put 100% of their capital into a single high-risk options trade on a meme stock. This is the polar opposite of Elder's philosophy. A single bad trade can, and often does, wipe out their entire account. The 2% rule is the ultimate antidote to this reckless behavior. It forces a level of discipline and diversification that is completely alien to the YOLO mindset. The 6% rule is also a crucial tool for today's trader who is constantly connected to the market. A losing streak can be psychologically devastating, and the temptation to immediately win it back is amplified by the ease of trading on a mobile app. The 6% rule acts as a mandatory cooling-off period. It's a professional's version of putting themselves in timeout to prevent a bad situation from becoming a catastrophic one. These risk management principles are also highly relevant for the crypto world. The extreme volatility means that a position can lose 50% of its value in a matter of days. Without a strict 2% rule and a predefined stop loss, a trader can be financially ruined by a single market crash. Elder's rules provide the structure needed to participate in this high-risk/high-reward market in a sane and sustainable way. It allows you to speculate with a small, defined portion of your capital without ever putting your core financial health in jeopardy. Elder teaches us that a true professional is not defined by their big wins, but by their small, controlled losses. Modern context expansion. What would Dr. Elder say today? If we could bring Dr. Alexander Elder into our modern financial world, he would likely feel like a psychiatrist who has just been handed a set of the most fascinating and dangerous case studies he has ever seen. The technology would be new, but the human behaviors on display would be deeply, fundamentally familiar. He would see his core principles, especially the primacy of psychology, validated on a scale he could never have imagined. The tools of the trade, Robinhood, AI, and the digital crowd. First, Dr. Elder would be horrified by the gamification of trading. He would look at apps like Robinhood and see them not as tools for investment, but as expertly crafted psychological traps. He would analyze every feature through the lens of a psychiatrist. Confetti animations, a classic use of variable rewards, the same mechanism that makes slot machines addictive. It creates a dopamine hit associated with the act of trading, not with the quality of the decision. 0.0 commissions. He would argue that while this seems good for the consumer, it removes a crucial point of friction. That small commission in the old days forced a trader to pause and ask, is this trade really worth it? Removing it encourages a high volume of low-quality, impulsive trades. Social and viral features. The list of most popular stocks and the ease of sharing trades on social media are designed to trigger her behavior and FOMO. He would conclude that these apps have created a global population of what he calls amateurs, people who are trading for emotional reasons, with no plan and no risk management. He would see it as a massive, institutionalized system for transferring wealth from the undisciplined to the disciplined. He would be intrigued but deeply cautious about AI-based investing and quantitative models. As a man who believes in systematic approaches, he would appreciate the method aspect. He would love the ability to backtest strategies and remove human error from execution. However, his psychiatric training would make him focus on the weak link in the chain, the human operator. He would ask, what happens when the AI model has a 15% drawdown? Does the human have the psychological fortitude to stick with the system? Or will they panic and pull the plug at the worst possible moment? He would argue that until you can build an AI that manages the investor's fear and greed, the human mind element will always be the ultimate arbiter of success or failure. The modern strategies, index funds versus day trading. Dr. Elder's 3Ms provide a crystal-clear framework for evaluating today's popular investment strategies. His view on index funds and the passive investing strategy of the FIRE movement would likely be overwhelmingly positive, but with a crucial caveat. He would see it as an excellent method for the average person because it is simple, proven, and removes the need for individual stock selection. He would also approve of the built-in money management through diversification. However, he would stress that index investing does not solve the mind problem. The strategy only works if the investor has the psychological discipline to continue buying during bear markets and to avoid selling during crashes. He would say that the greatest value of a good financial advisor is not to pick funds, but to act as a behavioral coach, a therapist, who helps the client manage their emotions and stick to their plan. He would view the modern culture of day trading with extreme skepticism, seeing it as a violation of all 3Ms. Mind. Day trading maximizes psychological pressure. It forces rapid decisions under stress, which is a recipe for emotional mistakes. Method. Most day traders have no coherent, backtested system. They are chasing random price wiggles and reacting to noise. Money. The need to make many trades often leads to poor risk management, as traders abandon their stop losses in the hope a trade will turn around in the next few minutes. He would call it a sucker's game, an arena where amateurs with slow connections and high emotional arousal are systematically taken apart by high-frequency trading algorithms and stoic professionals. He would argue that slowing down, extending your time frame, and giving yourself time to think is one of the greatest edges an individual can have. Timeless principles as a shield against modern risks. In our world of unprecedented speed and psychological manipulation, Elder's 3Ms are not just relevant. They are a survival kit. Mind as an antidote to FOMO. The practice of keeping a journal and achieving self-awareness is the ultimate defense against the powerful pull of the meme stock or crypto bubble. By understanding your own emotional triggers, you can recognize when you are feeling greedy and choose not to act. Method as a defense against chaos. Having a structured system like the triple screen provides a calm, logical process in a world of chaotic information. It allows you to ignore the noise from the news and social media and focus only on your predefined criteria for a good trade. Money as a shield against ruin. The 2% and 6% rules are a non-negotiable defense against the YOLO culture. They ensure that you can participate in speculative opportunities without ever risking financial ruin. They are the mathematical foundation of a long and sustainable career in the markets. Dr. Elder would conclude that the modern market has not created new problems. It has simply put the old, timeless psychological flaws of humanity on a massive, technologically amplified stage. The tools for self-destruction are more powerful than ever, which makes the internal work of mastering your mind, crafting your method, and managing your money not just a good idea, but the only path to survival. Closing reflection. 10 timeless lessons from trading for a living. As we conclude our deep dive into Dr. Alexander Elder's masterpiece, we are left with a complete and coherent philosophy for navigating financial markets. It is a philosophy that balances the internal and the external, the psychological and the technical. It is a roadmap for transforming yourself from an emotional amateur into a cool, calm professional. Let's distill this profound wisdom into 10 timeless lessons. Trading is an inner game first. Your success in the markets will be a direct reflection of your success in mastering yourself. The market is a mirror that reveals your emotional weaknesses. Do the psychological work first. The 3Ms are your foundation: mind, method, and money. You must be strong in all three. A weakness in any one leg of the stool will lead to collapse. Most people focus only on method. Professionals master mind and money. Become professional, not a gambler. Amateurs trade for excitement, hope, and the thrill of the action. Professionals trade from a written plan. Keep meticulous records and treat trading as a serious business. Decide which one you want to be. Cut your losses to survive. The single most important skill of a professional trader is the ability to take a small loss without emotional hesitation. Hope is not a strategy. A stop loss is your best friend. Your first goal is capital preservation. Before you think about how much you can make, you must think about how not to lose. The 2% rule is your shield against catastrophic loss, and the 6% rule is your circuit breaker against emotional spirals. The trend is your friend, so swim with the tide. The biggest profits come from identifying and trading with the market's main trend. The triple screen system is a powerful tool for ensuring you are always aligned with the market's primary direction. Think for yourself, not with the crowd. The market is a game of mass psychology. The crowd is almost always wrong at major turning points. Learn to be a disciplined contrarian who buys fear and sells greed. Keep meticulous records. A trading journal is your personal trading coach. It is the only way to identify your occurring emotional and tactical mistakes. You cannot improve what you do not measure. Divergence is a powerful warning. The concepts of bullish and bearish divergence on indicators like MACD and RSI are one of the most reliable ways to spot a trend that is losing momentum and is ripe for a reversal. Trading is a journey, not a destination. Becoming a successful trader is a process of continuous learning and self-discovery. There will be setbacks and losing streaks. The goal is not perfection, but steady progress on the path to becoming a disciplined, self-aware, and professional market participant. So, how can you, the average investor, apply these powerful lessons right now? Even if you never plan to be a professional trader, you can apply the 3 M's to your entire financial life. Mind. Start by understanding your own relationship with money. Are you an anxious saver? An impulsive spender? Create a written financial plan. The clarity of having a plan will reduce financial anxiety and prevent emotional decisions. Method. You don't need a complex trading system. Your method can be beautifully simple. A disciplined, automated strategy of investing a set amount of money each month into a portfolio of low-cost, globally diversified stock and bond index funds. This is a proven professional-grade system for long-term wealth building. Money. This is your personal risk management. Build an emergency fund of 3 to 6 months of living expenses. This is your stop loss for life's unexpected events. It ensures you will never be forced to sell your long-term investments at the worst possible time to cover a short-term crisis. By applying this professional framework to your personal finances, you transform yourself from a passive worrier into the calm, confident CEO of your own financial future. Elder's Path is not about finding hot stock tips. It is about building a system of discipline, self-awareness, and prudence that allows you to achieve financial independence with peace of mind. That is the true return of trading for a living. And there you have it. The complete, professional framework of Dr. Alexander Elder's Trading for a Living. It's not just a book about charts and indicators. It's a manual for mastering the one variable that will determine your success in any endeavor, yourself. It is a timeless guide to achieving discipline, controlling emotion, and managing risk like a professional. We hope this deep dive summary has given you a solid foundation and inspired you to bring a new level of professionalism and self-awareness to your own financial life. The principles we've discussed today are the bedrock of sustainable success in any market. If you found value in this breakdown of trading for a living, make sure to subscribe to Capitura and click that notification bell. We're on a mission to bring you the world's most powerful financial wisdom, chapter by chapter. And you won't want to miss what's next, because we're covering another classic that can completely change how you think about money and markets. Thank you for investing your time with us. Now go and be an intelligent investor.